This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of two videos on final flags. I'll begin by talking about small final flags, and then I'll move on to II final flags. An II pattern is an inside bar that follows another inside bar. So it's consecutive inside bars, and even a small pattern like 2 bars can lead to a major reversal. That II can be a small final flag. Sometimes a final flag can be as small as a single bar. We have a bear trend, very big breakout, an attempt to reverse, probably going to fail. And then we have a small bear flag, a 2-bar bear flag. And look at this. This became the low of the bear trend. Yes, we tested down here again. However, this is potentially the low of the bear trend. We have a 2-bar bear flag, and it led to a couple legs up. And then ultimately, you can call this a double bottom or a slightly lower low major trend reversal, and then a higher low major trend reversal. Usually when the channel is tight like this, the first reversal up is minor, which means probably either a larger bear flag or a trading range. In either case, you're probably going to get a deep pullback, sometimes to a new, slightly lower low. Minor reversal usually leads to an attempt to resume the trend, sometimes the trading range. In any case, chances are when you're getting a tight bear channel like this, and even like this, the first reversal up, if it's not clearly a major reversal, the first reversal up is probably minor, and you're going to get a deep pullback. Here we got a wedge bottom, 1, 2, 3. So 1, 2, 3. A decent bull bar, following another bull bar here, another bull bar here, another bull bar here. So good buying pressure here. I think this is a pretty good looking lower low major trend reversal. And then we have a higher low major trend reversal as well. This rally, 2 legs up, 1 pullback 2. You can call it a low 2. A moving average gap bar, a bar with a gap below its low and above the moving average, usually leads to the final leg of the bear trend before a major trend reversal. You can call this a double top bear flag. You can call it a breakout test of this breakout point. I think it's important to remember that even a good looking major trend reversal like this only has a 40% chance of reversing into a bull swing or a bull trend. Most of the time, either the bear trend resumes or the market goes sideways. And here, the bear trend ended and the market went sideways for about 30 bars. And then we got a higher low major trend reversal and another attempt up by the bulls. However, it still leads to a profitable trade, a profitable swing trade. If you bought here, it would be a swing profit getting out below that low, or holding for a second leg up and then exiting maybe somewhere in this tight trading range once the bull trend became more neutral, possibly at the end of the session. In the neighborhood of a measured move target, 2 legs down, huge sell climax, probably at least a little bit more down. After this big sell climax, you have to be expecting one more leg down, but sometimes that's all you get. When you see this 2-bar pullback, you have to be wondering, it might be the end of the bear trend, the final bear flag, and the breakout might reverse up, consecutive sell climaxes. Big sell climax, smaller sell climax. This could be a 2-bar final bear flag, and it was. Good context for a major trend reversal, and a good buy signal bar. And as I said, there are a lot of other very good buy signal bars as well. Here, a lot of bull bars closing near their highs. The bulls are getting stronger. When you see a lower low major trend reversal, the odds are good that either the market will be in a trading range and you're buying near the low, or it could be the start of a bull swing. So this is a very good buy. You manage the trade just like any other trade. If you're buying what you think might be a minor reversal, you're only looking for a scalp. A major reversal means you're looking for a swing trade in the opposite direction or a trend. Therefore, when you buy a reversal that you think might be minor, in general, it's better to be looking for a scalp. A major reversal, you can look for a scalp, but it's usually better to be looking for a swing profit, or at least to swing part of your position. Very tight bear channel, probably a minor reversal, although it could lead to the end of the bear trend. Traders buying here, chances are, even with a strong rally like this, you're going to have big down, big up, big confusion. The reversal will be minor, and the market will convert into a trading range, which means you'll get another leg down and an attempt at forming a trading range. Traders who buy here will take relatively quick profits. Get out maybe below here, below here, below here. You buy here, initial stop below that low. This is 2 times your initial risk, a reasonable location to begin to take profits. Also around the moving average, around this high, also a reasonable area to take profits. A breakout test of the breakout point here, a reasonable place to take profits. Here we have a major trend reversal, a double bottom or a slightly lower low major trend reversal, reasonable for a swing trade, either to here or you just hold until the bull trend ends or the session ends and you get out somewhere up in here. Tight channel, probably a minor reversal, although it could be major. This could be the final bear flag. And this is clearly a major reversal. A major pattern has a lot of bars, more likely to lead to a major swing. A minor reversal, not many bars, usually not enough to reverse a trend, usually leads to either a big bear flag or a trading range. If you buy above this bar, your stop is just below its low. A reasonable place to take at least partial profits is 2 times your initial risk. And you can see there was some profit taking here. It's also in the area of this prior high. Traders are aware that instead of this becoming a bull trend, it might simply be a trading range. And traders want to look to buy low, sell high. Buy low, sell high. And selling high can be bears selling to get short. It's also bulls selling out to take profits on longs. At this point, we're still in a bear channel. We have a lower low, and we're still getting lower highs. And therefore, we could get a new low, and we could still get a series of lower highs and lower lows. This then is potentially a leg in a bear channel, which means it's potentially another bear flag. A wedge rally, but a lower high. This is the start of a bull trend. It's also a leg in a trading range, and it's also a bear flag. You don't know which it will end up being in hindsight, but at this point, some bears will take the short. We have a wedge rally to a lower high. They'll take a chance that this is a broad bear channel and that this is a big double top. The market might fall below the neckline of that double top and fall for a measured move down. So this is a final flag in the bear trend. Just like this was a small final flag, this was a bigger final bear flag. It led to the end of the bear trend. This is also another bear flag. Even though it's a reversal up, it's still a bear flag as well. It led to a breakout, but the breakout did not go to a new low. So it is a type of final bear flag, but the bear breakout only went down to a higher low. Here, in this case, a triangle, a higher low major trend reversal. We have a lower low major trend reversal here, usually followed by a higher low major trend reversal, which we have here, and at least one more leg up. This triangle could also have been a final bear flag. We could have had a bear breakout and then a reversal up. Here, it was a final bear flag. We never got the bear breakout. We got a bull breakout of the bear flag. We had a good rally after the lower low major trend reversal, and this triangle became part of a higher low major trend reversal and a second leg up. Most traders would call this a triangle and a higher low major trend reversal and not a final bear flag. But in fact, it is a type of final bear flag. Just like this is a final flag, this is a final flag, and this is also a final bear flag. It's also a head and shoulders bottom, left shoulder, slightly lower head, and a right shoulder. We have a bull trend lasting 20 or more bars, and then a tight trading range. And a tight trading range late in a bull trend often is the final bull flag, and the breakout often fails and leads to a reversal down. A huge breakout above the tight trading range. Whenever you get the biggest bull bar occurring 20 or more bars into a bull trend, the odds are it'll be an exhaustion gap rather than a measuring gap. The gap between this close and this high, this close, and any of these highs, that gap is probably going to close. And then when you get a bad follow-through bar for the bulls like this, the odds are even higher that the gap is going to close. We might get one more little push up, but the odds are a big bull trend bar late in a bull trend after a potential final flag, it's probably going to be a second leg trap. Leg 1, pullback, leg 2, and then this bear bar closing near its low. Traders will short here, taking a chance that we get at least to the bottom of the buy climax. And once there, the market might fall for a measured move down based upon the height of that buy climax. We have a high 2 bull flag. Here's a high 1, here's a high 2. This became the final bull flag, even though the breakout did not go above the top of the bull trend. This was the last bull flag in this bull trend. So a small final flag. For the bears, it's a double top bear flag. Remember, when you get a big breakout bar like this, you'll have some bulls buying the close. And then they look at this bear bar and they say, uh-oh, that's not what I want. I'm disappointed. I want to get out break even. A lot of these buy the close bulls then place a limit order to get out break even. The market tried to get up there and did not let them out. And tried to get up there again and did not let them out. If you're a buy the close bull here, disappointed by this, trying to get out break even here and not filled, and then you try to get out break even again here and not filled, what's going to happen? You're probably going to wonder if this is an exhaustive buy climax and in the end of the bull trend, and you'll look to get out on the reversal down. And that's what caused the series of bear bars closing near their lows. The bulls who bought up here or anywhere in here are finally giving up, acknowledging that this is probably an exhaustive end of the bull trend and not a measuring gap leading to a continued move up. The bulls gave up and the bears started to sell aggressively, confident that, at a minimum, the market would get down to the bottom of the buy climax here or here. Also, the magnetic pull of the tight trading range. We should get down there as well. I'm going to finish up by talking about II final flags. An inside bar that is inside another bar late in a trend often becomes the final flag. We have a bull breakout here, and it's in a bull trend, and this bar is inside of that bar. Inside bar means the high is at or below the high of the prior bar, and the low is at or above the low of the prior bar. So this bar is inside that, this bar is inside that. This is an II pattern, inside, inside, II, consecutive inside bars. When it occurs late in a trend, it can lead to a reversal. Sometimes you'll get a bull breakout and then a reversal. Other times you simply get the reversal. We have an II bull flag after a buy climax. Every bull trend bar is a buy climax, and if it is a big bull bar occurring late in a bull trend, 20 more bars into a bull trend, the odds of it leading to a reversal become greater than the odds of it leading to a successful bull trend. Whenever I see an II pattern, I'm always assuming that it is a triangle on a smaller time frame chart. A triangle is a breakout mode situation, so 50% chance of a bull breakout, 50% chance of a bear breakout. II pattern is a small triangle, an II triangle, at least on a smaller time frame chart. Traders will look to sell the reversal down. It's breakout mode, so traders are looking for a swing down or a swing up. If we did get the up move, because it's a triangle, it's a magnet, the up move usually does not get very far before it tries to reverse back down. Bears will sell below that II after a possible exhaustive buy climax. This is an II potential final bull flag. It was the final bull flag. We never got a bull breakout. We got a bear breakout below the bull flag, but it was the final bull flag. Sometimes you'll have a bull flag that gets a bear breakout and not a bull breakout. It's still a bull flag, and in this case, it's the final bull flag in the bull trend. This is the dollar versus the yen, a 240-minute chart. We have a bear trend, and it reversed up. But look at this. We have an inside bar. Its low is at or above the low of the prior bar. Its high is at or below the high of the prior bar. It's an inside bar inside of another inside bar, consecutive inside bars, II. On a smaller time frame chart, it's a triangle. If you were to look at a smaller time frame chart, like 5-minute chart, you probably would see a triangle here. We went down, we went up, we went down, we went up, we went down, we went up. It's a breakout mode bar. 50% chance the breakout will fail in reverse, 50% chance the initial breakout will be successful. Here, we tried to reverse up. We tried to get a bull breakout above this small bear flag. We then got a bear breakout, but the bear breakout failed, and it failed again and reversed up. This is the final flag in a bear trend that went on for 20 or more bars. It's also after a sell climax, so this gap might be an exhaustive sell climax. It might be an exhaustion gap, the end of the bear trend. We did get a second leg down, leg 1, pullback leg 2, but this became the final bear flag in this bear trend, and it led to a reversal up. Any kind of a triangle, even an II pattern, it's a triangle on a smaller time frame chart. Any kind of a triangle late in a trend can become the final flag. It's a breakout situation. We got a bull breakout that failed, a bear breakout that reversed up twice and led to a swing up. II, 50% chance the initial breakout will fail. That's not a particularly good looking buy signal bar, this bear bar closing on its low. A lot of traders would wait to see if we reverse up strongly and then buy. Some bears would sell above the high of that bear bar, betting that the bull reversal will fail. Would bulls buy above this bear bar? Probably not in a bear trend. However, now we have a micro double bottom and a second attempt to reverse up from the breakout below this II bear flag, and this bar is a bull bar closing on its high. We have a bull bar here and a bull bar here. We're starting to accumulate buying pressure. This gap might be an exhaustion gap. This is a reasonable buy. This is a good buy. We have a very strong bull trend. It's climactic. Big breakout, and then another breakout, and another breakout, and another breakout. But look at this. This is a bull flag. It's only a single doji bar. However, it became the final bull flag in a very strong bull trend. spike and channel bull trend. So spike, pullback, parabolic channel. You can call it a parabolic wedge if you want. First push up here, pullback. Second push here, pullback. Maybe third push here, pullback. Another pullback, breakout, pullback, breakout, pullback, breakout, pullback. On a smaller time frame chart, this tail, first push up, second push up, third push up. This to me looks like a parabolic biclimax. You can call it a parabolic wedge. Different computers will use different bars for the numbering. It's a parabolic biclimax. And then when you get a small bull flag like this, after a parabolic biclimax, usually the market's not going to go much higher before you get profit taking. This little bar became the final bull flag after a series of consecutive biclimaxes. Each bull trend bar, each consecutive bull trend bars is biclimax, 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 biclimax. Here, a 4-bar biclimax, another biclimax. At some point, the stop is so far away, the bulls have to take profits. And that's what happened here. They have a micro double top, a pretty strong reversal down, closing near its low. Bulls will get out below this bear bar, and bears will sell, expecting at least 2 legs down. 1 pullback 2, maybe 1 pullback 2, maybe 1 pullback 2. When you have a series of consecutive biclimaxes like this, you have weak bears selling all the way up. And at some point, they stop selling because they keep buying back for a loss. And here, the weak bears are covering probably for the final time. And the bulls are using the series of biclimaxes, especially after this pause, to take profits. Their stop is far away. They want to reduce the position size. They know this is potentially a final bull flag that could lead to a reversal. A lot of bulls will take profits with this final breakout. And strong bears will start selling. They'll sell above this bar. They'll sell above that bar. They'll start selling bull closes, confident that the bull trend will not go much further after so many biclimaxes and without much of a pullback. The smart bulls, they're taking profits. They understand what's going on. Consecutive biclimaxes, a pullback. This could be the final bull flag. They're going to use this close to take profits. The bulls sell. So strong bulls sell, strong bears sell, and the weak bears finally give up. They end up buying back their shorts at the high, exactly where the strong bears are selling, and exactly where the strong bulls are taking profits. And those strong bulls are not looking to buy again 1 or 2 bars later. They're going to wait at least 10 or 20 bars before buying again. Otherwise, why would they get out? They don't want to get out and then buy 1 bar later. A strong bull getting out is only going to buy again 5 or 10 bars later. He wants to see if the bears can reverse the market. If the bears fail to reverse, then the bulls will buy. Here, the bears did a very good job reversing. Consecutive biclimaxes often have a small bull flag for the final bull flag. Sometimes it's simply a single bar. Here, you can call it 2 bars if you want. To me, the pullback, this bar below that low, is the pullback bar. It's a 1-bar bull flag, and it's only a doji, but bulls are aware after a series of biclimaxes, sometimes you get a very unremarkable bull flag, and it's the final flag in the bull trend. A very tight bull channel, so chances are the reversal down will be minor and lead to a trading range rather than a bear trend. However, it's a low-risk short. You short below the low of this bear bar, stop just above its high, and chances are we're either going to go sideways or down, and the bull trend will stop for at least 10 bars or so before the bulls will buy again. A very tight bull channel, more likely a minor reversal into a trading range, but sometimes you get a swing down like we did here. 3 consecutive bear bars, 2 closing on their lows. This is probably now always in short for at least a small second leg down. So 1 pullback 2, maybe. Very tight channel. This reversal up is probably minor and will probably go more sideways to down. Sell climaxes also often have final flags, and sometimes the final flags are small. A pair of bear bars, sell climax, small sell climax. You can call this maybe a 5-bar sell climax. A sell to close bear trend lasting about 8 bars, sell climax. And then a sell climax here as well. We have a small double top bear flag. This bar and that bar, a low 2 short, low 1, low 2. Late in a bear trend, after a series of 3 or 4 consecutive sell climaxes, you have to be thinking that the bears are going to take profits and then wait at least 5 or 10 bars before selling again, and the strong bulls will start buying using wide stops scaling in, betting that we will probably not get much more selling without the market first either entering a trading range or reversing up. The weak bulls, they get squeezed out here. The bulls keep buying and selling with a loss, buying, selling with a loss, buying, selling with a loss. And eventually there are no more weak bulls left. And all you're left with are strong bulls, and they're never going to get out. They're going to use wide stops, and they're going to look at this as value, and they'll keep buying every bear breakout, expecting that at some point the bears have to take profits, and we'll get a reversal up. The smart bears, they're no longer willing to sell. After a series of sell climaxes, they start taking profits. So the strong bears are buying, taking profits, and the strong bulls are buying, betting that we'll get a profit-taking rally. Even though this small double top bear flag does not look very impressive, it can be the end of the bear trend. When you have a series of sell climaxes, the final bear flag is often very small, 1 bar, here it's 4 bars, yet it can lead to a major reversal. A decent looking bull bar after another sell climax bar, in fact the best looking bear bar in 20 or more bars, that increases the chances that it's an exhaustive sell climax. The gap between the close of this bar, that low, the close of this bar, this low, probably will close, and the market will try to reverse at least into a trading range, possibly into a bull trend. Low risk, you buy above the high of this bull bar, closing near its high, stop below its low. High reward. Usually the market tries to go up to the top of the most recent sell climax. Yes, this high is the most recent sell climax. However, this is much more impressive. This is a reasonable target for the bulls. They're buying, not much risk, and reward much, much bigger than the risk. And the probability is pretty good. Maybe 50-50 probability. Once you start to get this and then this, the probability starts to go up. 50%, 60% that we're going up to this high. Higher probability, wait until you get the bear breakout. Buy this close, buy that close. Here we have a triangle, 3 pushes down, 1, pullback, 2, pullback, 3. I don't know if it's an II, it's very close to an II, but in any case, it's a high probability buy after this much momentum that will get at least a small second leg up. Higher probability to buy after you see the strong bull breakout, but the risk is greater. If you're buying up here, your stop is here. So you have more risk buying here than you do buying here because stop is only right here. And that's always the case. Once the market becomes a high probability trade, the stop is usually further away. So you have worse risk reward. Greater risk, stop further away. You're buying later into the bull trend, so less reward. However, a very good trade, very high probability trade. Here, a very good trade as well. Probability not all that good, but the potential reward is far greater than the risk. Traders who want the most reward and least risk take this buy. Those who want higher probability and who are willing to take more risk, they wait to buy here or here. Both have positive traders' equations. In this video, I talked about small final flags. They can also lead to major reversals. And then I moved on and talked about II final flags, consecutive inside bars. Even though it's only 2 bars, it can lead to a breakout and then a reversal. So you can have an II pattern being a final flag and a trend. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on final flags. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on wedges. In this video, I'm going to discuss what I mean by the term wedge. I use a broad definition to include just about any pattern that has 3 pushes, whether or not the pattern is convergent. This is a continuation of the list of reversal patterns that I've been discussing. And like all of the other reversal patterns, even wedges involve some type of trading range. For example, a final flag, or after the wedge reverses, is often a major trend reversal, which is usually part of a trading range. I always think of wedges as either a flag in a trend or as part of a reversal. For example, we have a pretty strong breakout here, and we have a bull bar, and then a second bull bar that led to a small reversal, and then a third bull bar. This is a wedge bear flag. It does not matter that the beginning of the bear flag began before the bull trend ended. That's common for the market in transition from a trend into a trading range or a trend into an opposite trend for the transition to begin before the trend ends. Wedge bear flag is a pullback, and that means chances are the bear trend will resume. A bear flag is a small trading range or a small bull trend. A breakout above a wedge bear flag is a reversal into a small bull trend. A wedge top is a reversal of a bull trend. We have a bull trend, and we have 1 push, 2 pushes, 3 pushes up. The trend line and the trend channel line are converging. It's a convergent channel. We got a bull breakout above the channel, and now we are reversing down. So a wedge top is a wedge reversal. A wedge bear flag is a pullback. Every bull channel is almost always a bear flag on a higher time frame chart. and a bull channel, 75% chance you'll get a bear breakout, either by going down or by going sideways. And then the market evolves into a trading range. And therefore, a bull channel is ultimately a bull leg in what will become a trading range. A wedge is simply a triangle where the triangle is sloped upward or sloped downward. There are often different ways to draw wedges, and wedges are often nested, smaller ones inside of larger ones. We have a bull breakout, a pullback, second bull breakout, pullback, and then a third rally and a reversal down. Some computers see the wedge as 1, 2, 3. Other traders see it as a larger wedge, 1, and then 2, and maybe 3. It doesn't matter as long as you understand what's going on. The market keeps trying to break to the upside and failing. You could say we have a strong bull trend here, and then a bear breakout. I did not draw the trend line. And traders will look for a resumption of the bull trend to fail. In this particular case, this is a wedge, higher high, major trend reversal. This, on the other hand, is a pullback in a bull trend. It's a wedge bull flag. You expect the market to resume up. Here, you expect the market to reverse down. This is a small bear trend within a larger bull trend. A triangle that's sloped upward, 1, 2, 3, 3 pushes up in a trading range. It's a triangle. It's sloped upward, so I use the term wedge. Convergent lines, you can call it a bull channel or you can call it a wedge. A rising wedge is a potential top. A bull channel, a wedge bull channel, is usually a bear flag. The odds are you get a bear breakout. There's overlap here. The breakout above this high, pulled back below the high. The breakout above this high, pulled back. The breakout above this high, pulled back. When you have a wedge channel where there's overlap, there's higher probability that you'll get the bear breakout. We're trying to get a bull breakout above the top of a bull channel. 75% chance that fails within about 5 bars, and you get a test of the bottom of the channel. That's not saying much when the bottom of the channel is so close, but given the entire picture, the bears might be able to get a test to the bottom of the channel, or even possibly a bear trend. Here we have a reversal bar, a close below the midpoint. It's only a doji, but it is a reversal bar, and it's a reasonable sell. Traders will sell with a stop just below the low of that bar and get filled here. Pretty good looking entry bar for the bears, and very good looking follow through. This bar is even bigger than that bar, and it's closing on its low. It looks like the market's going lower. A series of consecutive bear bars closing on their lows. Strong breakout, probably at least some kind of a measured move down. The goal is, after a wedge top, a swing down. 10 bars, 2 legs as a minimum reasonable goal. This could be the first leg, and then a small pullback, second leg, or this entire move down might be the first leg. And then the market might get a larger pullback and a larger second leg. Remember earlier I said there were different ways to draw this wedge. Some computers would say the top of this breakout is the first push, and maybe this is the second, or they may say first, second, third, and fourth push. They may say the wedge channel has 4 pushes up. Nested wedge, I view this as a large first push up, a pullback, second push here, and then pullback, and then the third push subdivides. So it's a nested wedge, a smaller wedge within a larger wedge that has a higher probability of leading to a reversal. A wedge top, it's a climax, and like all climaxes, it usually leads to at least a pullback, or at least a pause in the buying. Climaxes can last a long time. A series of bull bars here, 5 bull bars, climactic move here, a series of strong bull bars here. The rallies within a wedge top are often strong enough often to be a buy the close rally. Traders will buy closes, confident that the market will go at least a little higher. The same with here. It's a buy the close rally, and here as well, even though the bars are small through here, these are buy the close rallies. At this point, look at the pullbacks. Only 2 bars down here, 1 bar here, 1 bar here, 2 bars here. We have a part of the large wedge that is also a small pullback bull trend, which you can call a short squeeze. The shorts are getting squeezed. The bears who keep selling reversals are being forced to buy back their shorts by bulls buying below the lows of the bars, more buying than selling. A small pullback bull trend is also climactic and unsustainable, and therefore it's appropriate that it's occurring within a wedge, which is usually made up of a series of climaxes. Small pullback bull trend, it's a FOMO trend, fear of missing out. the bulls are buying because of momentum rather than because of fundamentals. They're not buying up here because it's cheap. They're buying up here because the market's going up and they think it'll continue up because the pullbacks are small. FOMO trades, fear of missing out trades, are crowded trades. Everyone's long, and once traders start to take profits, everyone exits in a panic. It just takes a couple bars here to make all of the traders who bought during the last 10 bars now holding losing positions, and they're going to be very quick to get out. That happens all the time with crowded trades. When too many traders are long, they're going to be quick to get out. They know they're buying based on momentum, and as soon as the momentum ends, everybody is going to be quick to exit. We have a bear breakout, first push down, second push down, third push down. You can call this a first push, you can call this, you can say this is a wedge, 1, 2, 3, and the bottom did not lead to much of a reversal. You can call this a wedge. Bear trends are always forming wedge bottoms. Bull trends are always forming wedge tops. This is a wedge because it's a bear channel, a wedge bottom, it's a bear channel, and the lines are converging. We're getting overlap. If you're looking for a wedge bottom, you want overlap. You want the pullback from the second leg to go above the low of the first leg. That increases the chances that if you start to get a reversal, it'll be a successful reversal. You can draw a channel line. We have a reversal up, reversal up. You can draw a line. And here we're breaking below the line and we're reversing up. Failed breakout below the bottom of the bear channel. That's good for the bulls. Strong reversal bar. A little bit of a micro double bottom. This bar went down and up, and then we went down here and then up here. Good for the bulls. Bulls will buy above the high of that bull bar or the high of this pullback bar. The goal of the reversal is 10 bars, 2 legs. Approximately. It could be a lot more, usually not much less. So first leg up, pullback, second leg, or a complex first leg up, pullback, second leg. Another goal in a wedge reversal is a test of the top of the channel, either here or here, and ultimately we reach both. Whenever you have a sell climax like this and then a reversal, one reasonable target is to get just a little bit above that high, which we got over here. The goal of every market is to find a price that will attract the most trading, a fair price, a price that the bulls find good for buying, the bears find good for selling. And to find that fair price, it's constantly changing. There's constant information coming into the market. Every fair price is constantly changing. The market usually has to go too far one way to find out how far enough is. And that's what happens with a wedge bottom. The market's probing for a bottom, and then at some point decides it has gone too far, and the fair price is probably higher. So it reverses up and starts probing in the opposite direction. You see 3 pushes down, and the legs down are getting smaller. Plus you see overlap. The pullback from the second leg goes above the low of the first leg. There's less interest in lower prices. The market sees the buying pressure. They see that the bulls who buy at this low can make money. They assume the bulls who buy at this low will make money. Less interest in buying lower. The reversal attempts are coming after fewer bars. The bears are deciding that this price is too low to sell. They only want to sell higher. And the bulls believe that the market fell too low and that it's a good value, and they start buying. They start buying below bars, and then they're starting to buy with stops on reversals up, confident that we've gone too far down. Both bulls and bears buy. The result is a reversal. Usually, when you get a reversal, you get a couple legs up because you get trapped bulls and bears. You have bulls who did not buy initially. They're trapped out. They're hoping for any kind of a pullback to buy. That results in a second leg up. And you have bears who did not get out on the reversal up, and then they see this and they decide, okay, it's going higher. And they look for any reversal down so they can buy back their shorts with a smaller loss. The result is you have bears trapped into shorts, and they're looking to get out, and they buy. You have bulls trapped out of a long. They're hoping for any kind of a pullback, and they buy. The result is a second leg up. We're selling off here. Not all that strong. Big bear bar, small bear bar, pair of bear bars, bull bar, bear bar, doji. This looks like a bear leg in what will become a trading range. You have to think that we have a little bit of overlap here, so a negative gap here. It's also a small pullback bear trend. And that has an element of long liquidation. Bulls keep buying, and they decide they bought too soon, they have to sell, they have to liquidate. and that's happening repeatedly here. A tight channel, a small pullback bear trend, that is climactic. Here it has a series of small cell climaxes. A wedge bottom usually has different types of cell climaxes within it. Here we have a 5-bar sell to close type of cell climax. These bear trends can last a long time, and they can create a pain trade. Bulls see what they believe is a weak, broad bear trend, and they keep buying. However, they keep buying and they keep losing, and they start to feel a lot of pain. A pain trade is a low probability event, and that just goes on a long, long time. You look at it and say, wait a minute, how can this suddenly be getting so much stronger when we had bad follow through all through here? The bulls see this reversal up, they start assuming we'll get a major trend reversal, yet the market keeps going down. So the bulls who are buying are experiencing a lot of pain, and pain trades usually have at least 2 legs, 1 pullback, 2. Sell to close as a FOMO trade, fear of missing out. The bears sell not because the market is expensive, they sell because it's going down, and they believe it'll go down at least for a small second leg. And the result is they're not selling because of fundamentals. They're not selling because the market's expensive. They're selling based on momentum, and as soon as the momentum stops, everyone is trapped into shorts and they suddenly give up. It's a crowded trade, too many traders short, and once the momentum down ends, the bears buy back in a panic. Crowded trades often lead to sharp reversals. The bears give up, and when you get these sell climaxes, the trades are usually crowded, too many traders short. Remember, a wedge is simply a triangle that is sloped up or down, and a triangle has 3 pushes up or down. As soon as I see 3 pushes, here up, 1, pullback 2, pullback 3, I think this might be a wedge top, and higher probability of a reversal if the lines are converging, as they are here. There are always multiple ways to draw patterns. I'm picking this. Some computers will say this is the first push, second push, third push. Here we have 3 pushes up, 1, 2, 3. It's a triangle, and since it's mostly horizontal, traders would refer to this as a triangle rather than a wedge. There's also a bear trend, bull breakout, higher low, major trend reversal, and a double bottom, higher low, major trend reversal. Traders buy for the reversal up. You can also call it a head and shoulders bottom, left shoulder, head, and then right shoulder, and the right shoulder formed a double bottom. If you have a channel, you have a pair of lines. If they're sloped up, it's a wedge, and it can be a bear flag and a bear trend, or it can be a top and a bull trend. Here we have a wedge bottom. Does not look like a wedge, but it is. We have 3 pushes down, 1 pullback, 2 pullback, 3. A small double bottom created the first 2 pushes, and then the third push here. Again, different computers use different reversals to create the lines. Some computers will say the wedge began here. Others will use the pink lines and say the wedge began here. Some will say we had a wedge top here, 1, 2, 3. It tried to reverse down and failed. And then we broke to the upside, and the breakout above the wedge is failing. Another way to draw this wedge bottom, 1, 2, 3. Whenever you have a wedge, you assume there's going to be a 75% chance that you'll get a breakout in the opposite direction. A wedge bear flag, you expect a reversal down. A wedge top, you expect a reversal down. Wedge bottom, a downward sloping wedge, you assume you get an upside breakout. A rising wedge, 75% chance you'll get a break below the bottom of the wedge, either by going sideways or by going down. Whenever I see a bull trend, whether or not it's a wedge, if it's in a channel like this, I think of it as a bear flag because I know the odds are there'll be a bear breakout either into a bear trend or into a trading range. A falling wedge, a bear channel, 75% chance there's going to be a bull breakout. A triangle, 50% chance you'll get a downside breakout, 50% chance you'll get an upside breakout. 50% chance the first breakout will reverse. We have a triangle, we have a bear breakout, and it reversed. Is this a wedge top or a triangle? This high is slightly above that. This high is slightly above that. We have 3 pushes up. However, the pattern is mostly triangle. What do you call it? A wedge or a triangle? Doesn't matter. The forces are the same. 3 pushes up, in a channel, convergent, 75% chance in general. If it's a wedge, 75% chance you get a successful bear breakout. The flatter it is, the more it's a triangle, 50% chance you get the downside breakout, 50% chance you get the upside breakout. The bulls tried to get an upside breakout, and we see a decent sell signal bar. It's a reasonable short right below the low of that bear bar, betting on a failed breakout above a triangle or a failed breakout above a wedge. We're breaking below the bottom of the pattern. Is this a failed breakout? We're trying to reverse up, trying to reverse up? Well, it is. However, it's also 5 consecutive bear bars. Chances are there are sellers above, and we'll get at least one small leg down. The bears therefore see this as the start of that second leg down, and they see this as a bear flag. They see the whole thing as a bear flag. We have a bear bar, bad follow through after the bull breakout. Traders will sell just below the low of that bar, and they'll get filled on this bar. Is this really a failed breakout below the bottom of the wedge? Well, I think it's more of a pullback than a failed breakout. We did not get above the top of the triangle or the top of the wedge. This is more likely a pullback from this 5 consecutive bear bar breakout. Wedges are very common and they're present on all charts, but they're rarely perfect. In fact, most of them don't look like wedges at all. Here we have a wedge bear flag. We can draw a line down here. We can draw a line here. You can say, well, wait a minute, Al, there are only 2 pushes, 1, 2. But yes, however, there's a double bottom. We tried to go up here. We tried to go up again. We have 2 reversals up, 1 and then 2. That means 2 pushes down, 1, and then this little bear bar 2, and this is a 3rd push down. When you have a double bottom and a breakout below it, that is a type of a wedge. Bear bar, bull bar, bear bar, bull bar, and 3rd push down here, a wedge bull flag, a wedge pullback after a strong bull breakout. If you want, you can call it a triangle and say the first push down was here, which means this strong bull bar, in fact, was part of the pullback from this initial breakout. As strong as this is, some computers see this bull bar as part of the triangle, the pullback from this initial breakout. 3 pushes down, bear breakout, first push, and then a second push, and a third push. Not really converging lines, but still I think of it as a wedge bottom, and I look for a bull breakout. Wedge top, you can say, well, what are you talking about wedge top? You got 1 push, maybe first push here, and then are you calling this a second push and this a third push? Yes, this is a breakout, and therefore it's a push. And then we have a second push here and a tail, 3rd push here. This is a small wedge nested within a larger wedge. This is the first push. Other computers will say that's the first push. In any case, it's a bull channel with slightly convergent lines. I think of it as a small wedge top. And on a smaller time frame chart, it might be a very good looking wedge top. We broke below the bull channel, might get a second leg down, and we rallied up with 3 or 4 pushes, 1, 2, 3, and 4. This is a wedge bear flag, and we got a small second leg down. Leg 1, pull back, leg 2. Very tight bull channel, not convergent lines, but a series of biclimaxes, 1, and then 2, and then pull back, and 3. On a smaller time frame chart, this is probably a wedge. You could say this is the first push, second push, third push, doesn't matter. You have 2 or 3 pushes in a fairly tight channel. I normally would not call that a wedge. However, you can think of it as a wedge, at least an inferred wedge on a smaller time frame chart. You expect a bear breakout. You don't necessarily expect a big bear swing like that, but sometimes you get it. Maybe this is the first push, second push, maybe first push, second push here, and then third push there. Different computers look at it differently. In this video, I talked about what I mean when I use the term wedge. Basically, I mean any pattern that has 3 pushes. It's more reliable if the 3 pushes are in a channel that is converging. However, any 3-push pattern is a variation of a wedge. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on wedges. I'm going to begin by making the point that wedges are rarely perfect. I'll then move on to talk about how most channels are wedges, whether or not the channels are convergent. And finally, I'll discuss the many different types of wedges. Sometimes a wedge has a leg that's only a single bar, and sometimes it's simply a doji bar. This leg, 2 bars down, this leg, a couple bars down. Here, the third leg, maybe it's this bear bar, maybe it's these 2 bear bars with that low. 1 bar down, 2 small dojis down. Here we have 4 legs, 1, 2, 3. Some computers will say this is 1, 2, 3. These are small patterns, and they're probably clearer on smaller time frame charts. However, I would not go looking at the smaller time frame charts. You can infer what's going on simply by what you see on this chart. Different computers use different bars to count the legs. Doesn't matter. Is this the first push-up or is this the first push-up? Doesn't matter. Both computers, no matter how you do the count, see the same thing. They see a bull channel, maybe convergent lines. They expect a bear break below the bull channel. Again, very tight channel. Does not look like a wedge here. However, you can infer that it's a wedge on a smaller time frame chart. 3 pushes down here, and it's not really convergent. However, 3 pushes down, context is good for a wedge. We have a spike, pullback, and then possibly a channel. Strong enough breakout here for at least 1 more leg down. So 1, 2, 3, traders will look for a reversal up. The closer something is to that ideal, the higher the probability that it will behave like the ideal. So the better looking a wedge, the more likely a lot of computers and traders will trade it like a wedge, and therefore more likely you'll get the reversal. Wedge bull flags, we have a bull trend, and a wedge bull flag here, wedge bull flag here. In these bull flags, we have a couple bear bars here, 1 bear bar here, a couple bear bars here, 1 bear bar, another bear bar. And the bear bars are attempts to create a bear breakout. For the bulls, the bull bar that follows that bear bar is a pullback from that bear breakout. So we have a bear reversal or bear breakout, and then a pullback. Another bear breakout, another pullback. Another bear breakout, and another pullback. At some point, the bears decide that all of these strong bear breakouts are not working, and they stop selling, and the market then ends up going the other way. All of these reversal attempts are minor, and therefore part of a trading range or a bull flag. Wedge bear flag. The bull legs are sometimes small, 1, 2, 3 bull bars, and they're attempts to reverse the bear trend. Here, we tried to reverse up, failed. Tried to reverse up, failed. Tried to reverse up, tried to reverse up, and failed. Traders see this as a bull breakout, and then pullback from that bull breakout. Another bull breakout, pullback from that breakout. If the bull breakouts repeatedly fail, the bulls eventually give up, and the market goes the other way. Reversals in trading ranges are common, and a lot of the patterns are wedges. We have a bull breakout here, and then we have a small bear trend that's not falling very far, but this bear trend, this bear channel, I would call it a wedge bull flag, and we got a bull breakout. The pullback ended, or the pullback was a wedge bull flag. And that's true here as well. We're trying to trend down. We have a lower high, we have a lower low. It's a bear channel, but it has a wedge shape, and here it's only about a 50% pullback in a bull trend. The odds are this wedge bear channel is going to have a bull breakout, and therefore it's a pullback in a bull trend. Here we have a sell-off and a pullback, and this pullback has a wedge shape. It's a small bull trend. We have higher highs and higher lows, but the odds are you're going to get the bear breakout, so you can call it a wedge bear flag. Here as well, even though it doesn't really have a wedge shape, if you want, you can call it a wedge bear flag. A bull trend, but a minor reversal, and a bigger bear trend, maybe about a 50% pullback. This is really not a good example of it, but the idea is that you have a bear trend, about a 50% pullback, and you can infer that it's a wedge on a smaller time frame chart. So it's a wedge bear flag. The same is true here. This has a little bit better wedge shape, but it's a wedge top. Wedge bottom. I like to connect the first point with the third point. That means the second push is often below the line. Here's the start of the wedge, possibly the end of the wedge, and I ignore that second point going below the line. And that's true of a lot of wedges, that if you connect the first and third points, the second point is often beyond the line, and that's okay. Different ways to draw this: 1 or 1, and then 2, 3. I talked about this earlier, that we have a bull breakout here and then bad follow through, a pullback, and that this resumption up, some computers see it as part of the pullback. Even though it's a new high in the bull trend, it could be part of the pullback that began with this bar. Some computers see this whole thing as a triangle, which means this big bull bar, in the minds of some computers, is part of the pullback from this initial breakout. Most wedges are not perfect. Any 3-push pattern qualifies, and therefore most channels are wedges. By the time you decide that you have a channel in front of you, you have 3 pushes, and therefore it's a type of wedge. And again, the closer it is to ideal, the higher the probability that you'll get a profitable reversal trade. 3 pushes up, again, I connect point 1 with point 3. If I use point 1 and point 2, point 3 will not reach the line. And I like the reversal to be taking place at a line. So if I see this bull bar and then a bear bar here, I think of it as a wedge. I draw a line, 1, 2, 3, and I ignore bar 2 going above the top of the line, overshooting the line. Most spike and channel trends end with wedges. Strong bear breakout, so you think of it as a spike and a first push and a potential wedge. 1, 2, 3. Nested patterns are common. We have a big spike down here. We have a smaller spike down here. I mentioned that I think of wedges and channels as synonymous, and if they're convergent, I call them wedges. If they're more parallel, I simply call them channels. Reversal up with a decent buy signal bar. Whenever I see 2 reversals, I start drawing lines. I connect the lows and extend the line and see what happens. If we reverse up here and come back down here again, I would have a potential wedge bottom. I want to see what happens if we come back down toward that line. Do we reverse up? We went sideways and we had another bear breakout, but look what happened when we got right next to the line. We have a doji bar, and then we have a micro double bottom. I think of this as a wedge, even though the shape of it is not all that good. The third push down did not quite reach the line, and therefore you have to be wondering, are we going to go a little bit lower? This is an undershoot. Undershoot means the push did not quite reach the line. Because traders are wondering if it's going to continue down a little bit further, buying above this bar, low probability. Higher probability to take a second entry buy. Here we have a micro double bottom and a second entry buy with a decent buy signal bar. And the result, we got a very strong bull breakout and at least a small second leg up. Again, as soon as I see 2 reversals, I draw lines. Reverse down, tried to reverse down, I draw a line. And then I see what happens when the market gets back to that line, if it gets back to that line. And here we touch the line, went a little bit above it, and we have a bear bar. So this is a potential wedge top. Probably a minor reversal after such a strong breakout. Minor reversal means trading range, more likely than bear trend. Small overshoot, that's a buy climax. We get the reversal. If you get the bull breakout and a reversal down, you have an increased chance of a swing down, especially with a pretty good sell signal bar here and a decent entry bar here. The bars are pretty small here, so this looks like it's not going to go all that far or all that fast. Usually, if I start to see this, if I short that and then the market does this, I just get out. Reasonable to short below the wedge, spike pullback channel, expecting a test of the bottom of the channel, but it took a lot of bars to get there. And as I said, I typically get out when the market starts to do that very tight range. Just because I see it as a wedge does not mean that all the computers see it as a wedge. Also, different computers will use different reversals to create the wedge. A bull breakout and 3 pushes up, so a small wedge top. Other computers will say, well, maybe the wedge top is 1, 2, 3, and we did not quite reach the third touch of the line. Maybe you want to call it an expanding triangle top. I don't know, but some computers will see the 3 pushes as 1, 2, 3. Other computers will say 1, 2, 3. and not call it a wedge, simply call it a bull channel. And then look for a reversal down, especially a second reversal down. First attempt, and then second attempt. The market tried 3 or 4 times to break to a new high, and it's failing. Instead of finding buyers eager to buy the bull breakout, it's finding sellers. Every time it goes above something, it's reversing. Above here, reversing. Above here, reversing. Above here, reversing. The bulls and bears are agreeing that the price is too high. It doesn't matter if you call it a wedge, an expanding triangle, or channel. The market continues to reverse after every attempt to break to the upside. Usually then, the market tries to go the other way. It'll conclude it has gone too far up. Again, you can call it a wedge with a bad shape. You can call it an expanding triangle, a failed breakout above a wedge top, wedge 1, 2, 3. It doesn't matter. The market's repeatedly trying to go up and failing. You have to be thinking it may try to go the opposite direction, so traders will be looking to sell a reversal down. Either below that reversal bar, bull body, or higher probability below this bear bar closing near its low. As I said, there are many ways to draw the lines, and different computers use different algorithms, and they draw the lines differently. 3 pushes down, 1, 2, 3. Other computers will say the first push was here, 1, 2, 3. This push down from here was followed by a new high. You have a bear channel, but markets often transition, and there's often a time when it's both in a bull trend and in a bear trend. And that's why you can get a bear trend beginning before the bull trend ends, because you get the transition phase when the market is in both. You can draw the line 1, 2, 3 and call this an undershoot, did not quite reach the line. As I said, if I see a reversal up from a third push down, I usually connect the first point and the third point when I'm in my chat room to illustrate the wedge. Repeated reversals on sell-offs. Traders will look to buy a reversal from a third push down. Here, different ways to draw the 3 legs down. 3 pushes down, 1, 2, 3. Not a very good looking buy signal bar, plus it's following 2 bear bars. Usually higher probability to wait for a second entry, which we got above this bar. A bull breakout, bad follow through, first push down, second push down, third push down. An undershoot did not reach the line, and after this initial reversal attempt, we went to a new high. This bull bar, you can call it part of the bull trend, or you can call it part of the pullback from this initial breakout. Again, bull trends, when they transition into bear trends, usually have a period of time when it's both in a bull trend and a bear trend. Wedge bull flag, bull breakout, traders will buy above a bull bar here, here, and here. This is not a bull bar, but it's a wedge bull flag. Other traders will buy above this bar, a bull bar closing on its high. This entire sell-off, approximately a 50% pullback from this breakout. You can call it a wedge bull flag, you can call it a higher low major trend reversal. Traders are going to look to buy reversals up. Wedge top, 1, 2, 3, with a bear II, an inside bar with a bear bar. Traders will take that short. Micro double top, up here, and then down on that bar, and then up and then down on that bull bar. I'm now going to talk about different types of wedges. Take a look at this. We have clearly a bear breakout and a second leg down, but here we have a bear breakout as well, but it formed a higher low. This, in fact, is a type of a wedge pattern. There are 3 pushes down. Had this low gone below that low, you would call it a wedge. But what happened here is this is an undershoot. The third push down did not fall below the second push down. In fact, it did not get anywhere near the trend line at the bottom of the wedge. However, the forces that form this pattern are the same as those for a wedge. When the bulls saw this reversal up, they knew there might be one more new low. However, they were so confident that there would be buyers below this low that many bulls started placing limit orders above this low, just in case the market did not fall there. And the result was we have a higher low and then a reversal up. However, it's a 3-push pattern, 1, 2, 3. If you want, you can call it a truncated wedge, but it is a wedge. And the bulls who bought here were buying because they assumed that if the market got below 2, there would be a lot of bulls buying there. And these bulls were just front-running the bulls who wanted to buy here. And the bulls who did want to buy the new low ended up having to chase the market higher. The bad shape, The lack of a wedge shape, the lack of a third push below the second, does not matter. It's the same forces that create this as create a wedge. You can call it a higher low. It is a higher low, but it's really a variation of a wedge. The market tried to get a bear breakout 3 different times, here, and again here, and failed all 3 times, and then it decided to try in the opposite direction. That's exactly what happens in a wedge. The market makes 3 attempts down. However, typically the third push is below the second. All 3 fail. The market then decides it cannot go lower, so maybe it's gone too low already, and then it tries to probe in the opposite direction. When the bulls and bears are both confident that a third push down to a new low will create a wedge reversal, many bulls buy early, and a lot of the bears take profits early. The bears are selling reversals up, betting that they'll fail. They'll sell here. However, if they're deciding that this is too strong a buy setup, a very good bull bar here, chances are there'll be buyers below. A lot of the bears will take profits early because they do not want to take a chance that the market might form a higher low. So the bears are starting to scalp out early, and the bulls are becoming very confident. A pretty good reversal here, very good bull bar here. Really not a lot of strong selling. There's some, but look at all the bars to the left. This is a sell-off, but very weak. Traders, both bulls and bears, are now confident that there's not much left to this bear trend, and the result was a higher low instead of a lower low, but it's still a variation of a wedge. Too many traders trying to buy around that second low. Bulls trying to buy for a swing up, and bears trying to buy back their shorts. Take a look at this. We have a double top, we have a head and shoulders bottom, left shoulder, head, right shoulder, or a double bottom, right shoulder, and we're getting a bull breakout above the neckline of the head and shoulders bottom, and a breakout above the double top. But think about what's going on. The bulls are trying to rally, they fail. They're trying to rally again, and they fail. And they're trying to rally a third time, and look what's happening. They're failing. This is a 3-push pattern. Anytime you have a double top and then a bull breakout, you have 3 pushes up. If that third push fails and the market reverses down, this is a variation of a wedge, and the computers will treat it like a wedge. 3 strong pushes up, each one reversing. They'll bet that the market has decided it cannot go up. Maybe it has gone up too far. Maybe it now needs to go down and find what price is too low. Bears, they see a double top bear flag, they'll sell the reversal down, and a lot of them will put their stop just above the double top, and they'll get out here as the market is going above the double top. The bears will buy back their shorts, and the bulls will buy as well. The bulls see it as a bull breakout above a double top, and they expect a measured move up. However, the market then reversed down, a big tail, and now a bear bar. Traders will start to sell. Bulls will sell out of their longs if they have not already taken profits, and bears will start to sell either here, or they'll wait until after they see many consecutive bear bars, and now we have a low 2 bear flag. Low 1 below this bar, low 2 below that bar, and they'll sell here. Higher probability selling after you see 3, 4, or 5 bear bars after the reversal down, but both shorts are reasonable here, or selling closes on the way down here. Three pushes up or down, that's not enough. They have to be strong compared to the other bars and the other legs. Context, the bars to the left have to make sense for a reversal. Otherwise, the market is only going to go sideways. Here we have a wedge, 3 pushes up, 1, 2, 3, but there's nothing to reverse. The market is really not going up all that much. It's simply part of a trading range, and therefore the reversal down is probably going to lead to more trading range. Leg 1 up, reversal down, not all that strong up. Leg 3 up, not all that strong up. Most computers will not consider this a wedge. There were not 3 strong pushes up. There was 1 strong push up here, but not 3 strong pushes up. Traders will see this more as legs within a trading range, and they'll expect more trading range, not 3 strong attempts to rally that are failing. Here we have 3 pushes down, 1, 2, and 3, or 3, or 3. However, it's in a tight trading range. There's really nothing to reverse. The market might go up, but more likely the tight trading range will continue. Markets have inertia, and they tend to continue what they've been doing. And if it's been in a tight range for 15 or 20 bars, it's more likely to continue in a tight range than it is to get a bull breakout and a resumption of this small bull trend. If a pattern does not look right, computers will ignore it, and you should ignore it as well. In general, traders will call it something else. For example, if the reversals are all around the same price, traders will call it a triple top or a triple bottom instead of a wedge. If the context is good and if the legs are strong, it's still tradable. 3 pushes up, maybe it's a wedge top. This is actually what I would call a small breakout of a small breakout. Here's a small breakout of this. This is a small breakout of that. It's mostly horizontal, and we have an attempt at a reversal down. There's a higher probability of a measured move up when you break above that. In general, if you break above any kind of a wedge, 50-50 chance you get a swing up, 50-50 chance you get a reversal down. But when the pattern is more horizontal like a trading range, and you get a small breakout of a small breakout, it's closer to 60% chance of a measured move up, a swing up. Pretty good bull bars here and again here. Increasing buying pressure in a trading range. The odds are we're going to get a bull breakout and a swing up. You can also call this a head and shoulders bottom if you want. Left shoulder, a lower low head, and then a right shoulder. You can call it a double bottom pullback, a double bottom, and then a pullback, which is a type of triangle, even though this low is below that low. Many different terms for the same pattern. For me, it's mostly a small breakout of a small breakout, where all 3 legs have good buying pressure, and there's an attempt at a reversal down after the 3rd breakout attempt. The market's also in a broad channel. We're getting higher lows and higher highs, and there was room to the top of that channel. If you have legs within a tight trading range that are strong enough, you can get a minor reversal, for a scalp in other words, but rarely will you get a swing trade. 3 pushes up, 1, 2, 3. Selling below this, we have a bear II, a bear inside bar, inside of another inside bar. The sell here is probably going to result in simply another leg in the trading range, and therefore a scalp and not a swing trade. 3 pushes down, 1, 2, 3, not all that strong. A second entry buy probably would be a scalp. Here, the bulls got a break to the top of the range, and then terrible follow through. Same thing here, 3 pushes down, not very strong. Basically, in a tight trading range, if you're taking this buy, you're probably looking for a scalp up to the top of the range. None of these has a wedge shape, but they all function as a wedge. The market made 3 strong attempts to go one way, and the breakout failed. The market gave up and tried the other direction. The same forces as in a wedge, but here the patterns are small and sideways. They're minor reversals leading to scalps. Usually, when I see patterns like that really don't look like wedges and the context is really not good for much of a breakout, I do not use the term wedge. I use other terms like a triangle or a triple top or a triple bottom, or simply call it a tight trading range. Instead of worrying about a wedge here, I would simply call it a tight trading range. I mentioned earlier, a breakout above a double top that fails is a wedge top. If you have a double bottom in a bear breakout and it reverses up, you have 3 pushes down. Computers will treat it like a wedge. Here we have an attempt at a double bottom, and we have a bear breakout. 3 pushes down, 1, 2, 3. To me, it's functionally the same as a wedge. I could have drawn a line across here. You can call it a triangle, you can call it a wedge, but it's the same forces that a wedge has, 3 pushes down. So if you get a breakout below a double bottom and it reverses up, it functions the same as a wedge, and you look for a reversal up. Here, in a tight trading range, you're not looking for much of a reversal. It turns out we got a pullback and then a second leg up, but in general, a breakout below a double bottom that reverses up is a type of a wedge because it's 3 pushes down and all 3 reversed up. The same here. We have a double bottom, and then we have a bear breakout, and it reversed up, and it reversed up a second time. I would not call it a wedge. I would call it a double bottom with a failed breakout. However, it is a type of wedge. 3 pushes down, all 3 reversing. Double bottoms, bear breakout, reversed up. They function as wedges. Here, double top, and a bull breakout that reversed down. It's 3 pushes up, 1, 2, 3, and all 3 are reversing. The market's deciding that up is not the right direction. It has to probe lower. It's a type of wedge. However, I usually refer to this as a failed breakout above double top. Same thing here. We have a double top and a breakout. 3 pushes up, 1, 2, 3, and then it reversed down. You can call it a wedge. It's a type of wedge. It's the same forces as a wedge. A lot of traders would simply call it a triple top or a failed breakout above a double top, or they would look at this and call it a tight trading range and a failed breakout above the top of a tight trading range. Big bear breakout, closing below the low of the wedge, closing below the low of the past 30 or 40 bars, probably going lower. Traders will sell the reversal down, or after this breakout, this is a bear flag, they'll sell below the low of this bar, betting that the bear trend will resume down. It's higher probability to sell after you see a strong bear breakout. I made the point in this video that wedges are rarely perfect. Also, most channels, whether or not they're convergent, are variations of wedges. And then I talked about some variations of wedges, like failed breakouts above double tops and failed breakouts below double bottoms. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on wedges. I want to begin by making the point that a bad wedge is not a reversal setup. It's not going to lead to a reversal. Next, very often when you have a wedge, the reversal trend, the opposite trend, begins before the old trend ends. If you go from a bull trend to a bear trend, or a bear trend to a bull trend, there's usually a transition during which time both trends are in existence. Finally, you can often enter earlier on a smaller time frame chart, although most traders should stay with just one chart and not look at other charts. The market's breaking to the downside, and again here, and again here. And you can count 3 pushes down, 1, 2, 3, and therefore a wedge. But a wedge alone is not a reason to buy in a strong bear trend. This bear channel is very tight. If you get a reversal, it's probably going to be minor. Bear trends are always forming wedge bottoms. 1, 2, 3, 1, 2, 3, 1, 2, 3. And just because you can count 3 legs does not mean it's reasonable to expect a reversal. A tight bear channel like this is a breakout on a higher time frame chart. When the market's in a breakout, a bear breakout, you should only look to sell and do not look to buy. Any reversal like this or like that, it's profit taking by the bears who will be looking to sell again soon. It's not a realistic attempt at a bull trend. The reversals become bear flags, not bull trends. And look at this, we have a leg down and we have a reversal attempt, but the high did not go above the low of the breakout point. There's a gap. We have another bear breakout, another reversal attempt, good looking bull bar, but it did not close the gap. This bear trend is forming gaps. When the legs do not overlap, when you're forming gaps like that, the bear trend is too strong to buy. Also, where are all the bull trend bars? Where is evidence that the bulls are strong? You have one bull trend bar here, but look at the follow through. And finally, the lines are not convergent. There's not a wedge shape. The stronger a bear trend is, the stronger the buy signal bar has to be to overcome the strength of the bear trend. And here, there are no really strong bull trend bars. There's a bull reversal bar here, a small one here. Does this small doji look big enough to reverse that bear trend? No. And the same with this. We have a good entry bar, but where is the follow through? We have a bull breakout and a very tight channel. And on a higher time frame chart, this is also part of the breakout. This breakout would be continuing up on a higher time frame chart. And when the market's in a tight channel like this, or in any kind of a breakout, only look to buy, do not look to sell. Bull trends are always forming wedges. 1, 2, 3, or 1, 2, 3, 1, 2, 3. You can count them any way you want, but all of those wedges are within tight bull channels, and therefore the reversals are minor, probably leading to a bull flag and a resumption of the bull trend, not a reversal. Remember my 80% rule. If you're in a strong bull trend, 80% of reversal attempts fail and become bull flags, and the bear scalpers keep losing money. They keep selling. They sell a failed breakout. They sell a final flag reversal. They sell a wedge top, another wedge top, another wedge top, another wedge top, and they keep losing money. In any trend, traders are always counting reversals. Reversal down, so the end of leg 1. Another reversal down, end of leg 2. And now we have a third leg and a pullback, end of leg 3. Whenever traders are counting bars or counting legs and they see a strong breakout like this, it's usually better to start the count over again. Instead of calling this bar 3, traders should call this bar 1. Whenever traders are counting legs and they see 3 pushes up, it's important to pay attention to symmetry. In general, you want the spacing to be about the same between point 1 and point 2 as it is between point 2 and point 3. If there's too big a difference between the spacing between point 1 and 2 and then point 2 and 3, computers tend to ignore this as a channel. Here there are 21 bars between 1 and 2, only 7 bars between 2 and 3. That is getting to be a little too asymmetrical, and traders tend to view this less as a wedge and more as a bull channel with more to go. This strong leg up, a lot of traders would restart the count and say this is point 1, this is point 2. Strong bull breakout, start the count over. This then is point 1, point 2, point 3. We have 3 pushes down, 1, 2, 3, convergent lines, and a gap, this high and the breakout point. That is a problem. Whenever there's a gap, even though this bar pulled back above the low of this bar, this is the bottom of the first push down, and we did not go above that low. Whenever there's a gap in your wedge, the channel down is usually too tight to begin looking for a reversal. Wedges usually need stairs. They need overlapping with the pullback from the breakout going above the breakout point of the prior leg down. As a sign of buying pressure, you could also call it a wedge 1, 2, 3, but same problem, no overlap, and therefore it's probably not a reliable wedge bottom. 1, 2, 3, and then start the count over, strong breakout, 1, 2, 3, still forming gaps. That means the channel down is too tight, and the reversal probably will be minor. The limit order bulls buying below bars are losing money. If the limit order bulls are losing money, the stop order bulls buying above bars probably will lose money as well. Therefore, the bulls are too weak to be looking for them to create a reversal up other than a minor reversal. The channel is very tight, it's not broad, no consecutive big bull trend bars, not enough buying pressure for a reversal, and therefore a reversal up is probably going to lead to either a bear flag and another leg down, or a trading range. And here it did both, tight trading range and a new low. Sometimes the legs in a wedge are subtle, and sometimes it's only a bull bar followed by a bear bar. This is a nested wedge. We have 1, and then a reversal down 2, and a reversal down 3, but the third leg subdivided into a smaller wedge, a bull bar and then a doji, a bull bar and then a bear bar, a pair of bull bars and then a bear bar. On a smaller time frame chart, it would be a wedge. On this chart, it's inferred. Whenever you see a bull bar and then a bear bar or a doji bar, that is a first leg. Another bull bar and then a bear bar, that is a second leg. Very tight bull channel here, and the entire channel is tight, and therefore the first reversal down probably is going to be minor, leading either to a bull flag or a trading range. Here we got a 15 bar tight trading range, TTR, tight trading range. Within it there's a small wedge, 3 pushes up, bull, bear, bull, doji, and then a third push. You often get a lower high major trend reversal when there's a tight trading range after a bull trend. It usually comes as some kind of a double top. You could say this bar is a double top with that bar. The probability, like most major trend reversals, is low, maybe a 40% chance you get a swing down. But if you wait for the breakout and then sell, the probability of lower prices and making money is higher. Selling late, the stop is further away, so the risk is greater. Selling early, the stop is close, the risk is less, but the probability is less as well. Both are acceptable. Here we have a wedge bottom, 1, 2, 3, and the minimum that traders need to see to conclude it's a wedge is a bear bar followed by a bull bar. So 1, pull back, and then 2, pull back, and then 3. However, there's a smaller wedge as well. A bear bar, doji, and bull bar, and then bear bar, bull bar. This is also a smaller wedge. 1, 2, 3. So different ways to draw it. 1, 2, 3. And the bulls got a higher low major trend reversal. They have a bear trend, possible final flag, lower low major trend reversal. Not much of a strong breakup, but we had several strong legs up. Traders will look for the bear breakout below this trading range to fail. This trading range then will probably be the final bear flag. You can call this a final flag reversal or a lower low major trend reversal. You could say bear trend, bull breakout by going sideways, and then resumption of the bear trend that failed. Good reversal up, and then a spike and channel down, spike, first push, second push, third push, with a good buy signal bar. I think it's important to realize that most reversals begin before the prior trend ends. There's a transition. Here we got a bull trend and a wedge bull flag. 3 pushes down, 1, 2, 3. But look at this push down. This bear channel, a small bear trend, began before the bull trend ended. And the same here. We have a push down, a new high, and then a second and third push down. You can call this a triangle or a wedge. This is the first leg down of this wedge channel, this triangle. Yet it occurred before the bull trend ended. The same here. This wedge bear flag, bear channel, began before the bull trend ended. And that makes sense. Usually a bull trend does not go into a bear trend. There's usually some kind of a transition. And the transition often is the first leg of the bear trend begins before the bull trend ends. The same here. First leg down and what became a wedge bull flag came before the bull trend ended, and the same here. You could say that the bull flag began here, 1, pull back 2. I think it's more realistic to say this was the start of the bear trend, and there was a transition in here where the bear trend was beginning and the bull trend had not yet ended. The same with here. You could say it's a high 2 buy, leg 1, pull back, leg 2. I think it's probably more of a wedge bull flag, and the bear trend and bull trend coexisted. There was a transition. The bear trend began before the bull trend ended, and the bull trend was still in effect even though the wedge bear channel had already started. This is how I would label it, 1, 2, 3, and the same here. I think this is part of the correction even though the bull trend has not yet ended. In any case, whether you call it a high 2, 1, 2, or a wedge 1, 2, 3, you're going to buy the reversal up, and the same with this as well. Legs can be small, sometimes as small as a single bar. You can look at a smaller time frame chart, but it's usually not worth doing. You can just infer what's going on by the appearance of what's going on the 5-minute chart. Here, we have a leg that is only a single bear bar, and it's followed by a bull bar. So to me, that's a leg down, and it ended with this bull bar. Here we have a few bars down and ended with a bull bar. Here, a few bars down, ended with a bull bar. Here we have a tail. The market traded down and traded up. On a smaller time frame chart, that is a small leg 1. We have a bear bar followed by a bull bar. This is a leg 2. We have a bear bar followed by a bull bar. That means it's a third reversal up. This is a small wedge bull flag. On a smaller time frame chart, you'd see it, but you can infer it simply by looking at this, and this is all that you need to see. The same here. A doji bar went down and up. We went down and up, and then we clearly went down and up. This is a type of a wedge pullback, even though it does not have a wedge shape. And the same here. We have a bull breakout and then a bear inside bar. That could be the first push of a wedge bull flag. In fact, that's how I would label this. You could call it simply a high 2, leg 1, pullback, leg 2. I would call it a wedge bull flag, 1, 2, 3, where the market transitioned. Here, it was still in a bull trend and it was in the start of a bear trend. The important thing is to realize it's a bull flag, so you want to buy the reversal up. Whether you call it a high 2 or a wedge, you want to buy the reversal up in every instance. A wedge bear flag, it's a small bull trend, and it can begin while the bear is still underway. There's usually a transition. The first push up can be a lower high in the bear trend, followed by a new low, but still part of the bull channel, the bear flag. For example here, strong reversal up, yet the bear trend continued. A second push up here, third push up here, you can call this a wedge bear flag, even though the bear flag began before the bear trend ended. The same with here. A transition, we're in a bear trend, yet we're starting to have a bull trend before the bear trend ended. There's usually overlap between the bear trend and the bull trend. There's a time when both are in effect. Here, I think this is the start of the bull trend, a bull trend bear flag. Every bear flag is a small bull trend, yet the bear trend still is working lower. You can call this two legs up, 1, 2, or you can say maybe it's a wedge bear flag where the bull trend began here, and then 2, and then 3. That's how I would label this. I would label this a wedge. I don't have the line drawn in here, but if you did draw it in, this would become a wedge-shaped pattern. Again, the rally, a wedge rally, it's a small bull trend, I think began here, while the bear trend was still in effect. This is a transition from bear to bull, and there's a period when both are still operating. The bull trend is beginning, the bear trend is still continuing, and this bear leg is part of the bull channel. The same here. As you can see, it's pretty common. Reversal up, the bear trend is continuing, but this reversal up is the first push up in a wedge rally. The key point, you're in a bear trend, you're looking to sell a reversal down from every rally, betting that the rallies are minor and therefore bear flags, and that the bear trend will resume. So you sell below the low of that third push up. You can enter earlier on the smaller time frame chart. I think traders will make more money if they just trade the chart that's in front of them and not look at other charts. This is the euro versus the yen, a monthly chart. Clearly a wedge bottom, 1, 2, 3, or 3. And then a good IOI buy setup here. Some traders will anticipate this, the reversal. They'll see the wedge, and they'll start looking at a weekly chart or a daily chart, or even a 60-minute chart or a 5-minute chart for a reversal that could lead to a swing trade up. A lot of times the first attempt will fail. Here we have a lower low. We have a wedge, 1, 2, 3, nested maybe, 1 or 1, and then 2 and 3. A reasonable buy, fairly tight channel, weak buy signal bar. This reversal probably is not going to be successful. But this one, we have a bear breakout, a good reversal bar, another bear breakout, another good reversal bar. Has a higher probability of success. If you're trading the monthly chart, you buy above the high of this bull bar, and here's your fill price, 99.18. Again, you could draw the wedge 1, 2, 3, or 1, 2, and then 3. Some computers do it one way, others will do it the other way. This is a daily chart of that same reversal. If you were buying on the monthly chart, this is where you would be buying, 99.18. On the other hand, if you looked at that monthly chart and you saw the wedge starting to form, you could look at a daily chart and try to enter earlier, like for example here, 95.21, or here, 96.91. This is the euro versus the dollar on a 60-minute chart. And you can see maybe we're forming a wedge. 3 pushes 1, 2, and it's starting to push up here, 3. You got a wedge bull flag, 3 pushes down, 1, 2, 3. If you're anticipating a continuation of the bull trend, then you might start looking for bull flags. And if you see a first push and a second push down, this is strong enough so that we probably are going to get one more push down here. You can take the trade on the 60-minute chart, buying above the high of this bar, or you can look at a smaller time frame chart for an earlier reversal. If you buy the wedge bull flag here, your entry is here, 1.0795. And this is the 5-minute chart. This would be the 60-minute entry right there, 1.0795. However, on the 60-minute chart, you saw the possibility of a wedge bull flag. You could look at a 5-minute chart for an earlier entry, for example, here or here, a micro double bottom or a triangle, 1, 2, 3. The entry price is 1.0780, about 15 pips lower than the entry on the 60-minute chart. I began by talking about how bad wedges are not reversal setups. Bear trends are always forming wedge bottoms that are bad and the market keeps going lower. Bull trends are always forming wedges that are bad and the market keeps going higher. A bad wedge is one where the legs do not overlap. It's not a stairs pattern. There are open gaps, or the channel is too tight to expect a major reversal. I then moved on to talk about how new trends begin often before the old trend ends. there's usually a transition from one trend to the other. And finally, I talked about how traders sometimes like to enter early. If traders are trading a very high time frame chart, a monthly chart, weekly chart, 60-minute chart, they will often look at a smaller time frame chart for an earlier entry. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on wedges.